The Federal Reserve is widely expected to raise its benchmark interest rate by 0.75% for the fourth meeting in a row on Wednesday, after 2 days of Federal Open Market Committee meetings. The Fed has two options, either to let the economy crash or let inflation shoot up. I know this is bad, but the Fed has no other option. We all know the target inflation is 2%, but we're very far from that number. Currently, we're at 8.2%. We'll have to wait and watch what the Fed is planning on Wednesday, November 2nd. The Federal Reserve will do two things. One, increase interest rates again, and two, provide an update on their plan. Here's a quick recap. The Federal Reserve let inflation get out of control back in 2020 during the pandemic. The Fed printed too much money, and they kept interest rates way too low for too long. Now the Federal Reserve has no other option but to hurt our economy to bring down inflation. Here's how it works. The Federal Reserve raises interest rates. What it does is this makes it more expensive to borrow money. House loans become more expensive, car loans become more expensive, business loans become more expensive, so this will slow down the economy. Less demand makes the prices come down, and this will slow down inflation. This is what the Federal Reserve is doing. We all know this is not the right way to go, but it is what it is. This game plan by the Federal Reserve is a painful experience for the economy. The question we all have is when the Federal Reserve is going to stop raising interest rates. I can tell you that it's not going to be on Wednesday, November 2nd. It's expected that the Federal Reserve will likely raise interest rates by another 0.75% for the fourth straight meeting. The move would take its benchmark interest rate that influences almost all consumer borrowing costs in the economy past levels not seen since a brief period between late 2007 and 2008. The Federal Reserve interest rate is currently at 3.25%. On Wednesday, it's going to be 4%. The Federal Reserve meets again on December 14th. At that meeting, it's expected that the Fed will raise interest rates by 0.5%. That would bring the interest rate to 4.5%. This coming meeting on Wednesday is very important because it's going to give us a better understanding of what the Fed is going to do in December. As of now, the expected rate hike is 0.5% in December. However, if the October inflation report is worse than expected, then the Federal Reserve may not be able to go along with their plan and might continue to stay aggressive. If the October inflation report is bad, then expect the Fed to raise another 0.75% again in December. This is going to hurt the economy more than it is. The stock market will crash. But the CPI inflation has been coming down, but it's not coming down as fast as expected. The inflation rate in June is 9.1%, July 8.5%, August 8.3%, and September 8.2%. If you look at the GDP, which is a measure of our economy in the first 2 quarters of the year, GDP was negative. However, in the third quarter this year, GDP grew at an annual rate of 2.6%. So according to the reports, the economy is apparently solid. This will make the Federal Reserve continue raising interest rates, not to slow down. Think about it logically. If GDP was negative and getting worse, then there would be pressure on the Federal Reserve to stop damaging the economy. But the third quarter reports say the economy is doing well. It's doing great positive GDP. So that's a call to stay aggressive. During the last FOMC meeting, Fed Chairman Jerome Powell said the Fed will also look at the jobs report as well in order to determine the interest rate hike. We're yet to receive the report for October, but for the month of September, the economy added 263,000 jobs. The unemployment decreased to 3.5%. The Fed wants high unemployment to stop rate hikes, but it's decreasing. There are two things here. The first one is this means that the labor market is strong. And two, this means there is wage inflation, adding to overall inflation. So this is a go-ahead signal for the Fed to stay aggressive. If you look at the data, there's a high possibility that the Fed will continue to stay aggressive against inflation. The Federal Reserve will start to slow down the interest rate, increases starting in December, so they're going to raise interest rates 0.75% this Wednesday, 0.5% in December, and then 0.25% more on February 1st. After February 1st, the Fed's plan is to stop raising interest rates and just leave the rates there for a few months to see how the economy does. They're going to take a wait-and-see approach. The next few weeks are very important. We have the October jobs report being released on Friday, then we get the October inflation reading on November 10th. I'll keep you updated and please subscribe. Thanks for watching. Until next time.